Thanks for joining us. I'm Alan Murray, the CEO of Fortune, and this is a Fortune conversation about the modern board and the importance of ESG measures we're holding in partnership with Diligent Corporation. Just a couple of housekeeping issues while people are still signing on and before we get started. First of all, today's gathering is an on-the-record session. It will be covered by Fortune journalists. And second, the conversation is meant to be peer-to-peer among directors and other C-suite executives. We want all of you to get involved. Use the chat to raise questions, make comments, but also I'm likely to call on many or all of you. If you don't want to be called on, turn your camera off, but if your camera's on, I consider you fair game. I don't think I have to tell anyone on this call that the last 2 years have seen an almost complete reframing of the corporation. What it is, what it does, who it's responsible to, how it's effectively led. We had a technology revolution that was overlaid by a healthcare crisis, that was overlaid by a social justice crisis, and then topped off by this kind of complete rethinking of how, when, and where we work. I can tell you in my career, I've never seen anything quite like it. And all of that is led for reasons that we can discuss over the next hour to a heightened attention on environmental and social goals. A huge increase in the last 18 to 24 months in companies making commitments to reach net zero by 2050 or sooner. A big increase in attention, serious attention and action on diversity and inclusion, a heightened focus on employee satisfaction and well-being. And what we want to talk about over the next hour is how all of that is changing the role of the board of directors. In a world of growing stakeholder capitalism, how does the board need to change? How does it work with the C-suite to ensure accountability for reaching all these new goals? How does it balance various stakeholder goals against shareholder returns? We've got a great group of experienced board members here from different industries. As I said, I want to get you all in the conversation, but I'd like to start off by asking two of you to kick off our discussion. Ann Sweeney, president of BUA Ventures, formerly with Disney, board member at Lego, the Mayo Clinic, and Netflix, and also Krista Quarles, who is a serial CEO, now CEO of Corel, board member of Kimberly-Clark and Affirm. And Ann, if I can come to you first, can you describe in the boards that you sit on how this has changed over the last 2 years?
Well, I'm not speaking directly about any of my boards, but what I've observed is that, yes, the importance of ESG has heightened. The conversations are more robust, and it comes from the top. I think the attention to environmental, social, and governance really starts at the top. And in order for any of this to be successful, and in order for any of this to be measured, you need buy-in from your entire organization.
And can you talk, is there any way to quantify the increase to, hours spent? Is this like one of the top 3 or 5 topics? What's your sense of the change?
Well, my sense of the change is that it is always on the agenda for, every board. Friends of mine who sit on boards outside of the entertainment industry and the medical industry, talk frequently about this subject being elevated. The conversation is deeper. Corporations have brought in people to be the officer of social change, be the officer of sustainability. We've seen, I think, a lot of investment across a number of industries in this area.
Krista, does that fit with what you're seeing?
Definitely. And I think, it's funny, just even the letters ESG, I can very specifically recall the first conference, it was pre-pandemic, where we were discussing and debating the issues. I would think if you kind of go back in time, though, 2017, I believe, was Time's Up. We started calling things diversity, and then it sort of got wrapped into this, social and governance construct. And now it's at the point where I would say we are measuring the number of shareholder proposals by topic. And I think what's interesting even there is how that has evolved. So if you look at a year ago, the number one, if you were to categorize them, shareholder proposal was around diversity. This year, diversity has gone to the bottom of the list. I don't know if it's because we solved it, or if everybody's just on board, and climate is now at the top of the list. And so in the span of a year, if you think about the capabilities that need to sit within a board ability set, we've flipped from, social and diversity to climate, and it's not like we can let up on any of them. And so I think it's the biggest challenge that I've seen is the multi-front challenge, depending on what that board or that company ultimately does, is what we've got in front of us. And how do we make sure that we're getting the right experts in each of the fields? We're leaning in the way we're doing, as Anne said, specifically from a leadership perspective, how are we rolling compensation into the mix? Should we compensate our leaders for zero carbon emissions? What would that look like? We certainly are beginning to compensate our leaders for diversity mix. And so watching how we put in different rules and regulations from a governance standpoint into the board in order to make those changes is, it's just stepped up all the requirements that we need as board members and leaders.
Yeah, so let me ask you both. I mean, how are the boards dealing with this rapid change? I mean, obviously boards are set up to provide strategy oversight, and you have your audit committee and you have your governance committee and you have your compensation committee, but all of a sudden when you're talking about net zero 2050 commitments, or you're talking about diversity and inclusion commitments, how are the boards changing, or how do they need to change to address all of that?
I think if a board is not talking about it or not talking about it in depth, they need to understand this. I remember years ago when I was at Viacom, we talked a lot about corporate social responsibility, and no conversation about ESG, but corporate social responsibility meant you had to be about something. You really had to be paying attention to your audience. And again, this is the entertainment industry a few decades ago, but I think that's evolved. And I think the conversation today is almost seamless. These things are all related. These things are connected in ways that employees understand. And Alan, you may know the study, but I read a while ago that a third of baby boomers take a job based on the ESG record, but 2/3 of millennials take their jobs based on the metrics that they see. I'm wondering, true, not true, because that obviously affects the talent you're able to attract to a company.
There's clearly something to that. I mean, we had a conversation the other day that Roz Brewer, the CEO of Walgreens, was involved in. Mm-hmm. And she talked about how all these issues are kind of conflating. You have the great resignation out there, you have the health crisis and the social justice crisis, and they're all kind of conflating to the same thing. So it's not, and part of that conversation, and this is what I wanted both of you to get into, was about, do you put this off in a separate committee? Is there an ESG committee? Or is it more fundamental, cutting across everything else the board is already doing?
Honestly, I think, to me, a great structure is having people within the organization, management, who are accountable for, DEI, and understanding that diversity is not about, the other piece that I'd really like to speak to is that diversity is not about ticking off boxes. It includes equity and it includes inclusion. So I think that sends a strong message to this new era of human resources in a company. So I think companies having officers within who are focused on this, but from my perspective, having a fulsome conversation about this at every board meeting and not isolating it as a separate issue. I think it really needs to be in the mix, and it needs to be in the mix all the time.
Krista?
Well, I think, to some degree, it upends the truths that we've held for, at least the last 40 years about what the purpose of a corporation is meant to be. And I think this profit maximization construct that PS was, I think began in the 60s, 70s, as you think about a planet with finite resources, it just isn't working. And so I think what you're now seeing the evolution, from capitalism to either conscious capitalism or circular capitalism, this idea that, there isn't an infinite loop of resources that you can just continue to pull out from the earth or its people. And I think what now is happening is that the purpose of the corporation has shifted such that if you are not also, and I think what's interesting about it from a lot of these, corporation standpoint is actually, if you do not do these things, you will not have profit. And so right. I think that what's, when you were talking about talent brand, it's also the overall brand. People don't want to buy things from a company that they feel is wasteful. I sit on the board of a packaged goods company, and just even moving our packaging to sustainability, we're trying to get a fully recyclable diaper. What would that look like, for the planet? And so I think that's the biggest change, is just the ethos of what is the true purpose of the corporation. Are we here just to drive profit, or is there something more? And if it's something more, how does that loop back into the fact that we do need to be sustainable and drive profit? And I think that's the exciting part for me, is that the companies that lean in and the companies that are forward thinking here are going to be the ones that have and drive the most profit going forward.
Yeah. Does it have to, I was going to ask if it has to come from the CEO, or if the board's role in this is making sure they have a CEO who is attuned to it, or can the board push the CEO to a better place, or hold the CEOs accountable with metrics on these things?
Honestly, I'll tell you, I think a lot comes from the consumer. Lego announced recently that it was getting rid of its plastic bags holding the bricks and substituting paper. And that came about because of letters from kids who were saying, I know this isn't good. And then look at a company like Everlane that founded themselves. I mean, I have a friend who's an advisor over there, and I'd never heard the term virgin plastic before. But, their ethos, is all about recycling and using materials differently toward a better end. So to your question, I think a lot of it is consumer driven, but if it doesn't start at the top, then I think the board has a responsibility to surface it.
Krista, same. Employees, consumer driven and employee driven.
And employee.
Yeah, I mean, to the comment related to what you were saying with Roz, we were in the Great Resignation, and every day employees vote with their feet, and and I have found, yes, you can have kind of that transactional relationship with your employee, but that only gets you so far. And you better create an emotional connection to what you're building and driving as an employee. And I think employees, if they see and don't believe in what is being produced at the end of the day, they're going to just go somewhere else, and they're going to seek out. And I think the pandemic has taught us, the kind of you only live once mentality. Like, why spend your time in an industry with a leader you don't believe in? And if companies aren't leaning in here, they're just not going to be able to hire effectively or hire the talent they certainly need to make the evolution.
So I want to bring in Henry and Seth and Marie and some others, but let me ask you, Ann and Krista, before we do that, to just sort of look forward for 10 years. How is the board's role going to change as a result?
It'd be great to think that every company would have so fully embraced these changes that the board's role would have diminished. That would be a great outcome. I don't think that's going to happen. But I do wonder about, I've been thinking about legacy companies. I do wonder how this movement will impact startups.
Yeah.
I would say that I hope in some ways that the role of the board doesn't change at all. And by board in this case, I'm talking about a forward-leaning, diverse, highly functional, communicating group of individuals who by virtue of their diversity, are giving perspective and point of view to a leader whose job it is to move that organization forward. And so I think for me anyway, it's the boards that are doing that today, I think will be the ones that hopefully survive. And if they can create a structure around that, it's probably likely though that you're bringing in more experts into the boardroom than maybe even you are today. You know, I know that that's a big thing, but if you're a dysfunctional, homogeneous board where you just golf together, I think those are definitely going the way of the dodo bird.
Seth, I wonder if I could call on you. I mean, Anne referred to startups. Beyond Meat is a startup, and a startup that was formed with the explicit environmental and social purpose. How do you view what's happening today?
Yeah, I mean, I think it's really exciting. I think there's some interesting dynamics where, you know, you do have to report numbers. So, you know, in a way, as a startup, we had always just internalized. We said, look, we sell more burgers if we're using 99% less water, 93% less land, and 90% fewer greenhouse gases than a beef burger. That's just a net positive. But we didn't take the time and investment to actually sort of put those. I mean, we did that. We got those numbers, but then we didn't quantify the overall impact. And so now we have to go back and do that, because the more institutional investors do want to sort of see that formal assessment. So it is important for startups to make sure once you graduate into a larger company that you have done that work. I think the other thing I would encourage from a board perspective is to really look at the impact. So frankly, I think some of these carbon offsets are greenwashing. You know, a company that can call itself carbon neutral, but is emitting tremendous amounts of carbon and then, you know, buying offsets isn't really carbon neutral. They're just sort of paying guilt money. And if I were a board, I'd say, let's look at the real impact of our operations, not what we do with our, you know, our guilt payments. And so I think that's where a board can hold.
Well, that's a really good point. And I would like to go back to Ann and Krista on that, because, you know, we spent a century developing metrics around shareholder accountability, and, you know, the audit committee knows what their job is, and they have all kinds of measurements and lots of help from Big Four accounting firms and others to tell them how to do that. This is a whole new world. You know, if you're using offsets, are the offsets real? If you aren't using offsets, are you making progress towards your goal? If the goal is in 2050, what do you have to be doing this year and next year to show that you're serious and not greenwashing? I mean, how can boards get their arms? That's just a massive new task. How can boards get their arms around it?
Yeah, Krista, why don't you go first on this one?
I don't know if I'm the expert, but I mean, I think the provocation around it is really a good one. I would say offsets are necessary, but not sufficient, in the sense that, you know, to expect every company to move at the same pace you know, I think what you want to do is create an incentive to get there. And I think at some level, you know, the pricing of offsets in theory should rise to meet the level, and therefore makes it more actually, or less painful actually, to be a company that is leaning in. So if you think about the capital expenditure required to go and change a plant, that, you know, so like there's a pretty material investment, and the time window for that investment is pretty significant. And, you know, you start looking at, you know, the next 10 years of offsets, and you look at building a new factory, if you will, that is efficient, that uses water differently, you start to equate those. And I think as a board, what's interesting about the board too, different potentially from management, is our time scale. You know, the average CFO, I think, is in their job for 3 years. The average CEO, I don't know if it's even 4 years or 5 years, but, you know, I think the average board tenure tends to be like 7 or 8 years. And so our ability to kind of think in a longer term time scale for what, you know, maybe it's Alan's question, like, you know, 10 years from now, like what do we need to do to make sure that this company is in a sustainable position? And we're going to force those changes maybe even more readily than a management team that is feeling hemmed into a quarterly set of results.
Yeah, you're right. The short-term thinking and quarterly thinking is not going to get anybody there. It really, and Krista makes a great point about the turnover of CEOs and CFOs. Who's going to carry this forward? You know, who's going to decide that this is baked into the doctrine of the company? And I remember when all we had were carbon offsets in the early days, and
That was the
everyone,
whole game, yeah.
that was the whole game. And it was all about the corporate jets and really, you know, in entertainment at least, you know, and nothing more. But I think people have become better educated and the conversation has expanded. So again, I think it's as much a cultural issue for companies, you know, as it is an ESG issue.
And do your boards use consultants or advisors to help track these things the way you would the way you do an auditor for the finances?
Across the entertainment spectrum, across medical, across companies like Lego, yes, there have been many consultants that have come in to help. But again, if it's not baked into the company, if it's not part of, you know, who you are, what you stand for, and part of what, you know, Krista was talking, employees, you know, what are they signing up for here?
Yeah.
You know, then it doesn't matter how many consultants you have.
I want to go to Henry McGee because Henry is the only person on the call who was my director when I was running the Pew Research Center. So I know him as a director directly, but I'd love to get your thoughts on what's changed and where we're headed.
Alan, thank you. And I really want to start by building on what Ann and Krista said. Ann spoke about how boards are increasingly aware that how the corporation is handling ESG is going to affect customers. Krista talked about how it's going to affect the ability to attract employees. I also think that boards are becoming increasingly aware that it's also going to affect their ability to get investors. And if they missed out on that before, both ISS and Glass Lewis have both announced that they are actually going to have withhold votes on those boards where they think the boards are insufficiently addressing ESG issues and issues related to DE&I. So if the customers and the employees didn't get their attention, the shareholders will now get will certainly now get their attention. In terms of the board responsibility, I think there's speak a bit about Amerisource Bergen, which is one of the boards I sit on. While the board has become increasingly, the entire board is focused on these issues, there's always and each committee is focused on it. You always are running the risk if everyone's in charge, then no one's in charge. So what we've decided to do at Amerisource Bergen is to take not only the charter, but the name of the governance and nominating committee and completely revamp everything. So now it's called the Governance, Sustainability and Corporate Responsibility Committee. And that committee is charged with overseeing all those activities, and they relate to not only what we've been talking about, issues of climate and DE&I, but also, and this really comes to the fore in January 6th, is how are the companies involved politically? Where does that where does that sit? And so the fact that in the last decade or so, and certainly has been accelerated recently, that boards, and as Chris was saying earlier, you know, a few golf matches a year and you're done. That you have to deal with all of these issues, whether they're political contributions, how diverse are your board and employees, what are you doing on sustainability issues? It's really impacted all boards, and the role of director has significantly changed. And I think it's going to remain. You have to say, looking to the future, I think it's going to remain at this level and likely grow as these issues become more complex.
Henry, that's really fascinating. I never fully understood the historical reasons why E and S got linked to G, you know, what the connection is. But at Amerisource Bergen, it sounds like you're making the connection formal. You're asking the governance committee to take on these topics in a formal way.
Yes,
Yeah, that's interesting. Brian Stafford, you know all, right? First of all, thank you for sponsoring this conversation and for the partnership that we're working on to build this community. But you have a lot of data. You hear from a lot of different directors, big and small companies. Are there consistent themes to how companies are dealing with this, or is everybody sort of groping a bit in the dark?
I think what we see across our client base is there is a lot of groping in the dark. I think if I look at even like Jen's question in the chat, are board members appropriately trained, on the new skills required to help them manage that? I think that's directly tied to your question, Helen. And I think the boards where there are directors who are appropriately trained or can leverage what's being done on another board, where you see a lot of that shared across boards, I think that you see more movement in the right direction. But I would argue, as you mentioned, carbon offsets have been around for a while, but I don't think we've really modernized much beyond that into what companies are required to do. We were doing a little bit of work internally at Diligent, and I asked our team to take a look at, to survey the companies that we work with who have made net zero commitments, net zero, 2030, and to ask, well, why not 2025? Have you done the work required to say, here's why we can't do it faster, or 2020 or 2030 sounds better than 2025. And so is that the reason why that is? So I think there's a lot of early thinking. I think there's a lot of pledges. There's a lot of basics, but I think across our client base, we would argue that there's still a lot of people who are looking for more direction, directors who are looking to know what they should be doing, to be able to help to guide and push their companies into the right direction. I think per some of the other comments, if you're in the energy space, or if you're in a space where you're either your employees or your customers or clientele really cares, you're furthest along. But I think, unfortunately, there's not as much sophistication across the general base of public companies, much less private companies, than I think we all would hope.
Yeah, and to Chris's point earlier, even with 2030 goals, you're talking about goals that you are not going to be met during the lifetime of the current CEO.
Totally. It's a great thing. It's a great thing to pass on to whoever's after you.
You do that.
Yeah, totally.
Jen, does that adequately address your question?
Yeah, thanks, Alan. I think it does. I also wonder, are folks looking to recruit different types of skills, rather than just upskilling the current board members? Are they going out there and actually recruiting more diverse members that may have the skills that are needed in this current environment around ESG?
Yeah, a completely new and different skill set. I want to go to Andrew Kasoy, who's been working on this longer than most of us, I think, co-founder, CEO of the B Lab, which has tried to put some formality around it. Andrew, you had a question for the directors. Do you want to share that?
I mean, I was really curious how much obviously investors are a pretty big stakeholder in all of this, particularly for corporate board members. And I'm in private boards, like the investors and the board members tend often to be the same people. But in the public companies, that's not as true. And so I'm just wondering, like, how much latitude you think boards feel from their investors on these kinds of issues, and do they need investor permission? And then there's like the age-old question is always like, does everything have to be done with a wink and a nod to financial materiality, so that like the ESG issues that you focus on in the boardroom end up being just the ones where you can show a direct link?
I'll take that one. I think
different than the ways in which a company actually has impact on its stakeholders might be different than the ones that are actually financially material from an investor perspective. And so there's a tension there. And I'm just curious, for those of you who are on boards, how you think about handling that.
Yeah, I'll take that one. I think what's interesting there is just how it's shifted. I would say like 3 years ago, it's like, you'd hear the mantra of like, oh, I don't know, we don't have the time to be diverse, or like, we don't have there's a pipeline issue, or there's this, like, woe is me, or it's not going to be, we're going to have to eat into our profits to be sustainable. And now ExxonMobil, right? You know,
Yeah.
you've got activists who are using the ESG card, and activism is big business. You look at the number of these funds that have grown, you know, the assets under management for activism, you know, 2 years ago versus today. So it is now big business. And so if you are a board that has no diversity on it, and an activist comes forward and puts through a slate, what is T-Rowe and Fidelity going to say? They're going to say, yeah, we like. And so what's interesting to me is just even in a really, really short period of time, how it became sort of a this or that. It's now a tool of investors to drive change in behavior.
Yeah, I think that's fascinating, Chris. And it really did just happen in the last 2 years. I mean, if you go back to when the Business Roundtable put out its statement in August of 2019, there was a lot of talk about, oh, what are the trade-offs? What does this mean for the investor? What about fiduciary responsibility? And now all of a sudden, as Seth was saying, we're talking about investor pressure to do all these things.
Hey, Alan, can I make a point too that might be a little bit, maybe Andrew, I don't know if this ties to some of the work you've done, but I actually could, I'd be willing to make the argument that, and this might be not obvious, but that private equity backed companies will actually move faster than publicly traded companies. And the reason why I say that's actually maybe different than people would think is there still exists a world where, and all the public company directors can talk to this, where you do get the letters and the commentary that comes from all the investors. And you decide what to filter through, how to prioritize, where it fits on the agenda, et cetera. You know, to Chris's point, you will have aggressive activists, but you will have, there's a little bit of a, how do I decipher or filter through what feedback from investors we'd like to put forward in, you know, our plans for next year and, you know, the way we incentivize management, et cetera. On the private equity side, it's actually different in that, to your point, Andrew, there is a, your board are your investors. And what we're seeing increasingly in the private equity back space is as private equity firms look to raise larger and larger funds, many of their LPs care more and more. And so if you're CalPERS or CalSTRS or Yale Endowment or some of the pension funds in Northern Europe, you're saying, I'm only going to put in a $5 billion check or whatever else it might be if you actually sign up to real ESG goals. And you have a different dynamic that exists in private equity where, you know, it's incentives drive behavior. And if the incentive for the GP is to drive more ESG, it very quickly becomes more of the incentive for the management team. And I think you will see over the next 5 years, private equity begin to make the argument that they are more better stewards of ESG than the public markets in a way that I don't know if people, there's some of you that says more companies will go private to avoid that. And I actually think that there's a decent chance you will see the opposite.
Yeah,
Brian, I disagree with you. And I just want to pick up what Krista said. Again, I don't know, go spend a half an hour with BlackRock, spend a half hour with T. Rowe Price, spend a half hour with Fidelity, and you come back and you tell me that it's not important to those publicly traded companies about ESG. They are, I would argue that because PE is not subject to either withhold votes or no votes from these huge institutional shareholders, that their incentive is a lot less than while it's true what you're saying about PE, I think it's a mistake to say that PE is going to focus on these issues in a way that publicly traded companies are not.
Just to be specific, I get the T. Rowe, the State Street, the BlackRock pushes. I mean, everybody reads Larry's letter. What my comment is that I actually think you will see more movement than people would expect within private equity. That is,
okay, but what you said, that's
independent.
You were suggesting that somehow PE was going to get the private equity companies were going to somehow outstrip publicly traded companies. And while I think PE companies will begin to take the steps, I think it would be a mistake to overemphasize that.
Henry, we'll have to come. Alan will have to invite us back in 4 years.
But it is a really interesting argument, because I do think it was fairly easy to say a year or two ago that the dirty assets would end up private and, out of the public eye. And so they could do whatever they want to. And if you talk to, Krista and I were at the Fortune Brainstorm Tech event at Half Moon Bay last week. Steve Ellis, who's the managing partner of the TPG Rise Fund, private equity fund with a focus on social impact. And he was basically saying, over time, TPG Rise it's not going to be impact investing. It's going to be investing, that this is the way private equity is heading. So he was making a similar point to Brian. My guess is it's just very hard because of the obscurity to know which funds are moving in that direction and which funds are saying, well, we'll take that coal company. It looks like the profits are pretty good.
Yeah, I was just going to add, I think there's a spectrum in private equity. And so, my bosses are KKR. So I'm steeply, deeply aware of what KKR's position is on this. And for sure, I would say that the leaning in, change management, growth oriented private equity, it's absolutely evident. And I think at the chipping pennies end of the scale of private equity, which there's still many of those out there as well, I still see that there's a bifurcation. Like I know a fund in the Bay Area here who, was told by LPs, like, you guys better get a female investor. And one of my girlfriends got called for the P, like she goes, they're like, we need a woman. And I was like, what year is this? That is the call from the both the investor and the recruiter. It's shocking. But so I do think that, I guess I agree with both Brian and Henry that at one end of the scale in private equity, I still think that there is, if there's cash to be gotten from coal, then there probably will be an investor to find it. I think it's then the question of the more innovative, forward-leaning, and where the growth equity of private equity has sort of matched with the growth equity of venture. And to some degree, those businesses have become indistinguishable.
Yeah, I'll come to you in a minute, Andrew, but Marie, we haven't heard from you yet. And I know this is something you spend a lot of time thinking about. I'd love to get your thoughts.
Oh, that's great, Alan. Thanks. And it's nice to see you again. I do think, from my perspective, I sit on a public board, Masco, a $7.5 billion company with great brands, Behr Paints, Delta Faucets, and we talk about ESG quite a lot. And I'm CEO of a private equity company, $2 billion, and my sponsors do not talk about ESG whatsoever. It's really, and so from the spectrum, you see it. And some of my customers are asking whether or not I have takeout containers, because we do food service equipment and supplies that are more sustainable. But other than one or two customers asking me about it, the topic doesn't come up in private equity at all. But around ESG, particularly on the public board side, I think it's really about adding new skills and perspective. So I think there's been a lot of focus on increasing gender diversity, which is a top priority, but more recently, we're seeing now a focus on enhancing racial and ethnic diversity in the boardroom. Now we're seeing activism, as was mentioned previously, climate and political. I think the metrics here will be critical to get it right, because to achieve the metrics that many of these companies are coming out with, it necessarily needs to be cost effective, and it needs to be in line with the goal of profitability. So I think we have to measure it right. I do think tying it to the compensation, not only of the CEO, but the CFO and probably the top 5 NGOs, it will help to make a difference. But I think it has to be in the company's DNA. So I think ideas for enhancing effectiveness of the board, they have to stay ahead of new developments and trends in governance. So we're seeing senior level decisions having a lasting impact on the enterprise. And what we're doing, one tactic we're taking, we're seeing a lot of focus on recruiting directors to provide advice to the board and chairs. We're using, as you mentioned, some external consultants to help the nominating committee. I sit on the audit and the comm committee, and now I've actually moved over to the Nom and Gov committee, because they're important governance issues ranging across the scale. And what we've seen, one tactic board has used recently to accelerate change is to increase their size. So there was a study done in the 2021 proxy year, and nearly 80 boards have expanded to add one or more women directors. And on top of that, they've expanded to increase diversity. And of the over 115 directors who have been added, that are diverse, about 37 are women. And I say that because as it relates to me, I get calls, multiple calls per week for boards and for CEO roles, and as well as operating partner roles at other firms. So you're seeing a lot of change happening in the public spectrum because a lot of the no votes or holding back votes is being impactful from an investor standpoint, from a public standpoint, but not so much on the private equity side.
Yeah, I want to go back to your point, Marie, about tying compensation to ESG to ES goals anyway, of the board members. Any of you seen that at your organizations? Just raise your hand if so. I won't put you on. Krista and Marie. Krista, how does that work?
What I've seen very specifically is just for diversity objectives, and that it is a slice of the overall compensation goal of leadership. And it's been in there for a few years now, and I think it is. I mean, what's interesting is it is a circular problem. Like on the one hand, the ones that are probably far leaning are, all in to get after it. And the ones that are not are probably not going to put that initiative in, I think. But what has been most evident from all of these things is just how quickly the groundswell of opinion, investor opinion, customer opinion has changed. And I think the big warning to boards is just don't get caught flat-footed and don't be last and don't be the one waiting because I think your company might suffer.
Yeah, I think that, sorry,
Marie. Go ahead, Ann.
No, I've been in conversations in past positions about being compensated for diversity, and one company that I worked with in particular, and it really felt pretty empty because it ticked boxes. It was not about equity and it wasn't about inclusion. And I think that's what gets lost. It's one thing to compensate to bring the numbers up, but it's quite another thing to run a company that is truly diverse and it is working as a diverse unit. So it's an imperfect tool.
Marie, you're on.
Yeah, Alan,
right?
we've been talking a lot about it at the board I sit on, and in particular, we have two very, very big customers, and they push the issue as well. So we've actually put it as part of what we call the Masco operating system for the CEO, and we've tied it to his compensation. Interestingly enough, we spent a lot of time on the social justice issue. It impacted him so deeply that he actually got emotional on our board call. And so he's taking it quite seriously, and he's put out metrics to that effect, and we're helping him through that. They've actually formed an African American forum at Masco, where I've actually headed up and talked to the employees and spent my time encouraging them that this is a great forum to help recruit, retain, and help promote employees in the organization. So he's been quite, our CEO, Masco, has been quite happy with the board's engagement around that issue. So it is real.
Andrew, so much has happened on this subject since you started the B Lab. I mean, there's been so much acceleration, and my sense at the time was you thought, well, wait, we have corporate governance structures that aren't working, and so let's create a new governance structure that takes these things into effect. But do you think they are working better now? Is the B Lab's purpose being sort of accepted and built into standard governance operating?
It's a good question. I mean, just so you guys know what Alan's referring to, when we started, when we created this certification called a B Corp, one of the elements of it was corporate governance, and we wanted companies to actually change their corporate governance structure so that they made themselves accountable to consider stakeholder interest when making decisions. Essentially, the ESG was built into the governance of the company. because we felt like it was it couldn't really get done in sort of like an upfront way with investors. And, there are now, and we actually ended up having to pass legislation in 40 states, most importantly, Delaware, to get that done, because actually a company that went further than sort of saying that it was going to consider these issues, but that actually said that they could be held accountable for them, like in their corporate articles, the Delaware Secretary of State would have rejected an amendment to the articles. And that led to legislation creating this new structure called a public benefit corp. And there are now, I think, a little over 10,000 companies that have adopted that, including about 30 in the public markets. So what we've seen, I think, is that more public companies are interested in doing it because it makes it explicit and it provides some more clear protection for boards and for executives to work on these issues without having to kind of like play the game or constantly figure out how to justify that to investors. And we've seen more investors that are willing to support it because they see it as consistent with how those businesses want to operate anyway. So it sort of like makes it explicit and creates some alignment. But I think you're right to ask, like, are more and more sort of mainstream companies doing it anyway? And I think the answer is clearly yes. I think the issue is that often still there's often still a misalignment with investors, and it's often not really built into the governance of the business. And I actually thought Kristen made a really good point about the length of service of a board member versus most of the executives of most public companies, that like that's the right place to put that change in governance.
Yeah. Seth, you have a somewhat different perspective on this, but you are in the public markets. Can you give us your thoughts?
Yeah, for me, I actually think in the public markets, demand outstrips supply. When we did the roadshow, we would go into each of these for Beyond Meat. We'd go into these places, and this person was sitting on $5 billion of ESG, and I said, "Well, where do you invest in consumer retail?" They're really at the time. This was 2019. I said, "There's really nothing in a portfolio that feels, at least from an environmental perspective, like it's progressive. It's maybe offset." So I do think I think if anything, some of these investment groups are going to be challenged. Public investment in institutions are going to be challenged, where there's a lot of demand for people who want to think they're investing in socially responsible or ESG investments, and then they start surfing through the portfolio and they wait, what's that company doing there? Yeah. So there's almost that's in some sense the bigger risk.
Which also suggests that we're still in the early innings of this game.
Very much so. Yeah.
And is there, back to Andrew's point, I mean, is there anything in Delaware law or in existing corporate governance that hinders you when investors, employees, and customers are pushing in this direction? Is there anything that hinders you from moving in this direction? And Andrew, if none of the directors have a thought on that, maybe you do.
So look, there's an age-old argument on this. The fact is, like, Delaware law doesn't say, the actual Delaware corporate law doesn't say anything one way or the other about ESG issues. It says companies can do what's legal. That said, Delaware law also operates on precedent. There are a bunch of court precedents that go back pretty far that state pretty explicitly that in the end, a company's got to be able to tie, and its directors have got to be able to tie decisions to financial materiality and to profitability for shareholders above anything else. So shareholder primacy is real in that sense, from a legal perspective, and clearly from a cultural perspective, that's true as well. And so, on the around the edges, I would say companies have got lots of if we're in the early innings, all companies, no matter what their legal structure, have got lots of latitude to do lots of things that could be improvements on where they are now. And on the other hand, if they want to go further, there are some constraints there, including Leo Strine, who was the chair of who was the head of the Delaware Supreme Court, would tell you that are real legal constraints. And for that, changes in legal structure can really be helpful. And I think there's a vanguard of companies that are doing that, even if we're in the early innings where lots of companies could be doing lots of things on the margins that would be better than they are today.
So we only have a few minutes left, but I'd love to ask each of you to sort of cast forward a decade and say, how is this going to develop? Where do we go from here? How will things change over the course of the next decade? And I'll start with you. Anne, you're going to have to, I'm going to wear your t-shirt. Anne said before we started that she was going to have t-shirts printed that say you're on mute. So I'm going to be the first customer.
You are. Thank you, Alan. You know, I think with this increased focus on ESG, with companies actually putting real resources against it now, not just, you know, the days that I mentioned earlier on carbon offsets.
Yeah.
I think we're in a position to make true progress on a lot of fronts, but I think it will require it really, yes, the boards will have to stay on top of it, but more than that, the CEOs are going to have to drive that into the culture.
Yeah. Krista.
What's interesting is just the type of companies that are going to get more of the capital at the end of the day. And I think, you know, when you see like a Rivian, you know, an electric vehicle manufacturer who's still kind of yet to realize itself, you know, getting the valuation that it's getting, I think where you're seeing is capital is flowing to this area. And I think it's going to hopefully, again, you know, hope's not a plan, but it becomes a self-fulfilling prophecy that, you know, capital is flowing to the areas in which the most likely winners of an ESG future will be.
Yep. Henry, your thoughts?
He needs the t-shirt too.
Henry, I'm going to wear the t-shirt for you.
Okay, sorry about
We
that.
have
And you're going to have a major business by the time this is over.
I have a feeling.
Just make sure they're recyclable.
Exactly. No, I would say this. I think while every person who's spoken today has remarked upon the speed of change, I don't think that there's any reason to look forward to think that speed and focus is going to increase because of all the things we've talked about. I do want to come back and say that it's going to be driven by customers, it's going to be driven by employees, and as Krista just pointed out, it's going to be driven by the market. That's where people are going to want to put their money into companies that are focused on this. And so I think that not only this trend here to stay, it's going to continue and is going to be baked into the basic responsibilities of the board, excuse me, to oversee this going forward.
Brian, why don't I let you attempt to wrap up what we've heard here, and then we can give everybody a couple of minutes back for lunch.
Yeah, no, look, I think building on what everybody's said, I think we're, if you want to fast forward through 5 years, I think much of the dialogue today beyond the Rivians of the world is what should we disclose? What are the metrics we should disclose? How do we actually report? And I would really hope that 5 years from now, it's more about benchmarking who is making the most progress. And whether you're doing it for your investors, whether you're doing it for your employees, whether you're doing it for your customers, I think it'll be really interesting to see how the dollars of incremental investment go towards the companies who are making the most progress, as opposed to just what should we report, who's going to demand what we report, et cetera. And I think that's where you're going to look and see a new set of leaders who look to really move the needles on elements of ES and G, and then the boards, obviously, who compensate and hold accountable for that ultimate progress.
Yeah. Great. Well, let me thank you all. Ann and Krista, thanks for kicking this off. Seth, Henry, Brian, Andrew, Jen, Marie, thank you all for participating in the conversation. I think it's pretty clear coming out of this conversation, the direction things are moving in and things that need to happen in order to solidify the movement. So it's very helpful. Thanks for taking the time. 4 minutes back to use however you choose to make your day better.